A couple is looking at listings. One of them points at a $2 million house. The rooms feel right, the street looks good. They're asking one question: can they afford to buy it? But the better question is what it costs every single year once they do. The listing shows the purchase price, that's the asset. But owning an asset has an annual running cost, and in Australian property, that running cost doesn't appear on any comparison website, mortgage calculator, or open inspection flyer. You have to build it yourself. When you own a home, money moves through four buckets: mortgage repayments, the biggest by far, maintenance and ongoing charges, the opportunity cost of your deposit no longer earning returns elsewhere, and in the benefit column, capital growth and the rent you stop paying to a landlord. We need to look at all four honestly. At 80% LVR on a 30-year principal and interest loan at 6%, a placeholder, not your actual offered rate, annual repayments on a $1 million home run around $58,000. $2 million doubles that. Before maintenance or anything else, the mortgage alone already consumes a large share of most full-time household incomes. Maintenance is the cost most buyers skip until something breaks. The rule of thumb: 1% of home value per year. On a $1 million home, that's $10,000. On $2 million, $20,000. Not every year is expensive, but some years are, and you need to have set money aside long before the roof decides. A 20% deposit on a $2 million home is $400,000, no longer earning any return. It's committed. At 4.2% gross, roughly what cash earns near the current RBA rate, that's $16,800 a year in returns you no longer collect. It doesn't appear on the mortgage statement, but it's a real cost. Add the three lines for a $1 million home: $58,000 in mortgage repayments, $10,000 in maintenance, $8,400 in deposit opportunity cost. You are looking at around $76,000 a year to carry the asset, before a single grocery, school fee, or insurance premium. $76,000 a year is around $1,500 every week in total carrying cost, not just the mortgage repayment. For a household earning close to average full-time wages, that is a meaningful share of take-home pay before the rest of life starts. That is the real floor for a $1 million home. At $2 million, every cost line roughly doubles. Mortgage around $115,000, maintenance $20,000, opportunity cost on the $400,000 deposit about $17,000. All in, you are carrying approximately $152,000 every year. This is where people stop. Doubling the price doesn't just double one line, it doubles all three at once. Deposit, loan, and maintenance all scale together. A $3 million home lands at around $228,000 a year. Not 50% harder than $2 million, 50% more dollars every year. For context, the ABS puts Australia's mean residential dwelling price at around $1.07 million as of late 2025. So a $1 million model is not a luxury exercise, it is close to the national average stock. This carrying cost calculation applies to a wide range of ordinary Australian households. Here is the question that sits in the middle of the maths. If ownership costs this much, what is it actually paying for? Because the benefit column is real and it is not zero. You do not carry a home purely out of stubbornness. There are genuine reasons people buy and are glad they did. Capital growth, not guaranteed but historically present in Australian cities over long periods. Forced savings through principal repayments, which build equity you eventually own free and clear. Stability for school catchments and long-term plans. And the rent you stop paying, imputed rent, is a real financial benefit that most renting comparisons undercount. Noted Melbourne values retreated around 1% from the November 2025 peak. On a $2 million home, that's $20,000 on paper, roughly 2 months of carrying cost before selling fees. Growth years exist. But you pay council rates, mortgage, and maintenance in every market condition, including the flat ones. Part of every principal and interest repayment builds equity. It is not spent in the way rent goes to a landlord, but it is still cash that leaves your daily liquidity. When you are planning the household budget for next year, it counts. The equity will matter later. The cash matters now. The 6% in this model is illustrative. Your bank's actual offer will differ. The test that matters: run the repayment column at your quoted rate plus 2%. If that version of the household budget holds, you are being conservative. If it breaks, you are being optimistic, and optimistic in property is where people get caught out. The 4.2% opportunity cost proxy assumes cash or term deposits, not shares, not super, which carry more risk and more variance. If you believe long-run equities earn more, that opportunity cost line rises further and ownership needs to clear a higher benefit hurdle. Your view of the alternative matters more than the formula. This model excludes a few things your real version should include. Stamp duty is a year zero hit, significant and state-specific. Council rates, strata levies, landlord insurance, and utilities add several thousand per year depending on suburb and property type. The all-in number we built is a floor. Most households carry more. If the alternative is renting, compare the full ownership carrying cost to rent plus renter's insurance and moving friction, not rent alone. If the alternative is living with family or an arrangement, the opportunity cost on the deposit is still real, but the rent column swings much harder in your. The model works because the scale is visible. To make it yours, swap in your bank's actual offered rate, get real quotes on insurance and counsel for your suburb, and set your own opportunity cost rate based on what you would genuinely do with the deposit if you were not buying. Now it reflects your household. Before you sign, one question: if growth is average for 5 years, not exceptional, not terrible, does the life this house enables still justify the carrying cost? If yes, you are not buying a spreadsheet. You are buying a constraint you have decided is worth the trade-off. That is a completely different kind of decision. 3 things to do before making an offer. Build the all-in carrying cost using your real mortgage quote, your suburb's council rates, and actual insurance figures. Stress test repayments at your rate plus 2%. Then ask the life question honestly, not the maths question, the life one. The real cost of owning a home in Australia is the mortgage, plus the maintenance, plus what your deposit gives up by not earning elsewhere. Add those together with your real numbers. Stress test the rate, ask the life question. The maths shows the carrying cost. Only you know whether the life is worth it. Full tables and worked examples at the link below.